Welcome to Business Education and Research. This video presents the details of the net asset value (NAV) of mutual funds, a cornerstone concept for any investor. Today we will unpack what NAV is, how it is calculated, the factors that influence it, and why it is crucial for making informed investment decisions in mutual fund investments. Understanding NAV. What is NAV? The net asset value (NAV) represents the per share value of mutual funds assets minus its liabilities. It is a vital indicator of a fund's health and performance, recalculated daily after the market closes. This metric provides a clear snapshot of what investors would theoretically receive per share if the fund were liquidated. How is NAV calculated? NAV is determined by dividing the total value of all the securities in a portfolio minus any liabilities by any number of funds shares outstanding. This calculation provides the price at which investors can buy or sell fund shares. This process involves regular valuation of the fund's assets, ensuring that the NAV reflects current market conditions accurately. The key factors influencing NAV. Market value of investments. The primary driver of NAV is the market value of the fund's investments. Changes in stock prices, bond yields, and other assets impact the NAV directly. Daily fluctuations in these assets require NAV to be recalculated to reflect the current market values. Fund expenses. Management fees, administrative costs, and other expenses reduces the NAV. These are typically deducted before the NAV is published. Regular deductions for these expenses ensure that the NAV accurately reflects the net assets available to the unit holders, shareholders. For example, if a fund incurs a daily expense of 10,000 on an asset worth 100 million, its NAV decreases by 0.001 per unit. This example shows how daily operational costs directly reduce the NAV, affecting investors' return. External factors affecting NAV. Market conditions. Broad market movements can significantly influence NAV as they affect the underlying asset prices in the fund. Market volatility can cause significantly day-to-day variations in NAV. Interest rates. Changes in interest rates can affect mutual fund prices inversely, thus impacting the NAV of funds holding bonds. This relationship is crucial for understanding the risk and returns in bond investment. For example, if interest rates rise, bond prices typically fall, reducing the NAV of the bond-focused mutual funds. This inverse relationship is a key for investors to monitor, especially in volatile economic times. NAV and fund performance. Indicator of fund performance. NAV growth over time can indicate a good fund management and asset performance, making it a critical measure for investors. A consistently increasing NAV suggests effective asset management and potentially profitable investment opportunities. Comparison with benchmark. Comparing a fund's NAV performance against relevant benchmarks helps assess its relative performance. This comparison is essential for investors to determine the competitiveness of the fund. For example, a mutual fund whose NAV outperforms the S&P 500 over a year suggests strong management or advantageous asset allocation. Such benchmarks serve as vital reference points for evaluating fund performance. NAV and investor decisions. Buying and selling. Investors buy or sell mutual fund units based on the NAV, making it central to investment timing and decisions. Accurate and timely knowledge of NAV can significantly impact buying and selling strategies. Assessing fund health. Regular tracking of NAV help investors gauge fund health and decide whether to stay invested or exit. It acts as financial health indicator, much like a stock price for a company. For example, a steadily declining NAV might prompt an investor to sell their shares to avoid further losses. This decision-making process is crucial for managing investment risk and optimizing portfolio returns. Misconceptions about NAV. High NAV equals high quality. A common misconception is that high NAV reflects a better fund, but it simply reflects the fund's value per unit. Investors should instead focus on NAV growth rates and underlying asset performance. Low NAV means discount. Investors often mistakenly think a low NAV means the fund is cheap, but it must be evaluated relative to fund performance and sector standards. This evaluation should consider more than just the numeric value of NAV. For example, a new fund might have a low NAV due to fewer accumulated assets and not necessarily because it is undervalued. This distinction is crucial for making informed investment choices. Strategic use of NAV in portfolio management. Diversification strategies. Understanding NAV dynamics can help in diversifying investment portfolios effectively. By analyzing different funds' NAVs, investors can spread risk across various asset classes. Timing investments. NAV plays a crucial role in timing investments, especially in systematic investment plans. Regular investments at various NAV levels can help mitigate risk and optimize returns. For example, in a SIP, regular purchases at varying NAV average out the investment cost over time. This strategy can lead to more stable and potentially higher long-term returns. NAV in specialized funds, ETFs and index funds. NAV calculations in ETFs and index funds follows the same principle but is influenced by real-time market changes due to their tradability. This dynamic allows for more immediate responses to market conditions. Hedge funds. NAV for hedge funds may include adjustments for illiquid assets, giving a different insight into fund value. These adjustments are necessary to account for the unique characteristics of hedge funds investments. For example, a hedge fund might adjust its NAV less frequently, reflecting the valuation dates of its illiquid holdings. This practice highlights the distinct investment strategies and valuation challenges in hedge funds. Legal and regulatory aspects of NAV. Compliance requirements. Funds are legally required to report their NAV accurately and consistently, ensuring transparency for investors. These regulatory requirements helps maintain trust and stability in the financial market. Regulatory oversight. Regulatory bodies monitor how NAV is reported and disclosed, protecting investors' interest. These regulations are essential for ensuring that financial practices meet legal standards. For example, regulatory changes post-2008 financial crisis tightened NAV reporting standards to enhance transparency. These changes were implemented to prevent misleading reporting and ensure investors' protection. Technological impact on NAV calculation. Automation in NAV calculation. Technological advancements have automated many aspects of NAV calculation, reducing human error and increasing efficiency. This automation ensures more accurate and timely updates of NAV. Real-time NAV tracking. New technologies allows for real-time NAV tracking, enabling quicker investor responses. This capability is crucial in today's fast-paced financial environment. For example, some platforms now offer intraday NAV updates, helping investors make more timely decisions. This innovation provides a significant advantage in optimizing investment timing and strategies. In this session, we explored the crucial role of net asset value in mutual fund investing. Understanding how NAV is calculated, what influences it, and how it impacts investor decisions can greatly enhance your investing strategy. Remember, NAV is more than just a number. It's a vital tool for evaluating and managing your investments effectively. Thank you for sparing your valuable time and watching this video.